Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden inside company filings. Today we are diving into the intricate world of the Pre-IPO and Growth Fund, looking at a filing that's a bit like a treasure map for investors, full of promises and potential pitfalls, before we unlock what's inside. If you love getting the real scoop on companies, make sure you are subscribed. And hey, we've built a fantastic community on Discord to talk through these filings, so join us there, it's linked in the description below. This document is essentially a prospectus, a company's introduction to potential investors. It's telling us exactly what this fund is all about, its goals, its risks, and how it plans to make money. Think of it as the fund saying, here is who we are, and here is what you need to know before you give us your money. The name itself tells us a lot. This fund is all about investing in companies that are either on the verge of going public, like right before their initial public offering, or companies that have gone public very recently and are still considered in a growth phase. Their main goal is pretty straightforward: to grow your money over the long term. They want to find those exciting young companies with big potential and ride their growth to appreciation. Now, how do they plan to achieve that lofty goal? Well, their strategy hinges on two main areas. First, they're looking at what they call pre-IPO securities. These are shares in private companies that are doing really well, have solid revenues, and are nearing a point where they might be bought out or go public themselves. Think of companies in fast growing sectors like technology or life sciences that are still private but have a lot of buzz. They might even invest in other investment funds that focus on these kinds of companies. Then there are what they call growth securities. This refers to stocks of companies that are already publicly traded but are still considered growth oriented. They track these by looking at specific growth indexes, like the MSCI Acqui-IMI Growth Index or the Nasdaq Composite Index. So it's a mix of private companies with high potential and public companies that are still on a strong upward trajectory. They may also get involved in secondary transactions, which means buying existing stakes in these private companies from other investors. One of the interesting details here is that this fund operates as an interval fund. What that means is it is not as easy to cash out your investment as it is with some other types of funds. They offer to buy back shares from investors only at certain times, usually quarterly, and not always for the full amount you might want to sell. So if you need quick access to your money, this might not be the best fit. They offer different classes of shares like F shares, S shares, and D shares, each with its own fee structure. F shares, for instance, seem pretty exclusive, only available to eligible investors who might have been part of a previous fund or have been specially deemed eligible. They are offering shares continuously, meaning you can buy into the fund pretty much any time. The initial price of a share was $10, and after that, you buy in at whatever the net asset value, or NAV, is at that moment. Now, this is where we need to pay close attention. Every investment has risks, and this fund is very upfront about them. They're not shy about saying this investment is speculative and involves significant risk. Of course, Therese market risk. This means that a lot of things outside the fund's control, like economic conditions, political events, or even global pandemics like COVID-19 or conflicts like the one in Ukraine, can negatively impact their investments. It's a reminder that the broader economy plays a huge role in how any investment performs. Given their focus on pre-IPO companies, they're also highlighting the risk associated with initial public offerings. IPOs can be super volatile, prices can jump around a lot, and it might be hard to sell shares quickly without affecting the price. Plus, some of these companies are quite new. This one is super important for this fund. They openly state they will invest in highly illiquid investments. This means it might be very difficult to sell these investments when they want to, or to get the price they believe they're worth. This ties back to the interval fund structure, highlighting that you might not have easy access to your money. They also mention risks associated with investing in other investment pools, like private equity funds or special purpose vehicles. This means shareholders are exposed to the risks of those underlying investments too, plus any fees they charge. Let's peek at the financials now to see what the numbers tell us. As of the 30th of September 2025, the fund is very new. They have total assets of $184,325. This is mostly in cash and deferred offering costs, which are expenses related to setting up the fund that they expect to be reimbursed later. To raise a liability of $64,325 due to the investment advisor. This suggests the advisor has covered some initial costs. Their net assets are $100,000. This is all attributed to F-class shares, and importantly, these shares are valued at $10 each. This $100,000 in F-Class shares was issued to the investment advisor as a seed investment, meaning they put their own money in to get things started. For the period from their inception in May 2025 to September 2025, their statement of operations shows no income and no expenses. This is because the fund was just getting set up and had not yet started making investments or incurring operational costs beyond what the advisor covered. The organizational costs were $64,191, but this was fully reimbursed by the investment advisor, resulting in zero net expenses. This tells us the advisor is covering the initial heavy lifting. By the 30th of November 2025, their total assets had grown slightly to $201,810. The deferred offering costs increased to $101,810. Total liabilities stand at $101,810. Again, we see liabilities like due to the investment advisor and payable for offering costs. The net assets remain at $100,000, with all of it still in F-Class shares. Now, let's look at a more recent unaudited schedule of investments for a related entity, ABS Global Pre-IPO LP, as of the 30th of November 2025. This gives us a glimpse into the kinds of things they are actually investing in. They have significant investments totaling over 59% of their net assets. In special purpose vehicles or SPVs, for example, they have an investment with an economic exposure to Canva, Inc. common stock through Goanna Capital 25 RLLC, costing $6,060,000 and valued at the same amount. They also have a substantial investment with economic exposure to Anthropic PBC preferred stock, held through an SPV called IP Co-Invest Horizon LP. This costs $3,262,187 and is valued at $3,263,424. These SPVs are often used to invest in private companies. And the fact that these are flagged as restricted securities and valued using net asset value rather than market quotes really drives home that illiquidity risk we talked about earlier. In total, for this related entity, investments are valued at over $45 million, with other assets bringing the total net assets to over $75 million. This gives us a clearer picture of the fund's intended investments, a heavy concentration in private, illiquid companies, often accessed through complex SPV structures. Analyzing this, the Pre-IPO and Growth Fund is clearly aiming for high growth potential, primarily through investments in private companies. This strategy offers the possibility of significant returns, but it comes with substantial risks, especially illiquidity and valuation challenges. The fact that so much of their exposure is through SPVs highlights the complexity and the indirect nature of their investments. While the fund itself has minimal financial activity due to its recent formation, the schedule of investments within the related entity paints a picture of a very niche, high-risk, high-reward approach. Their direction is aggressive, pursuing growth through pre-IPO and early-stage public companies, which is a valid strategy for long-term capital appreciation. However, the significant concentration in illiquid investments accessed via SPVs means investors must be prepared for the possibility of not being able to easily sell their stake. The opportunities lie in identifying the next big unicorn before it goes public, but the risks are equally large if those companies falter or liquidity freezes up. Overall, this filing reveals a fund with a very specific and aggressive investment mandate. It's not for the faint of heart or those who need quick access to their money. It's for investors who believe in the long-term growth story of private companies and are willing to tolerate the inherent risks for the potential of outsized returns. That's all for this deep dive on the Pre-IPO and Growth Fund. What do you think about their strategy and the risks involved? Let us know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more. And definitely check out our Discord community for even more insights. Thanks for watching, and we'll see you next time on Corporate Decoder.